Kokkie Kooyman from Sanlam Investment Management Global joins us now, and we've already pointed out that Kokkie is the repeat recipient of the International Investment Weekly Fund Manager of the Year Awards. So certainly congratulations are in order, Kokkie, and we have to ask you, what is the world's best financial fund manager doing in all the current uncertainty?
We stuck to our guns.
In terms of your guns, let's talk about where those guns are going and where they're blazing. What strategies are you embarking on, and are you continuing to embark on?
Yeah, going into the crisis and even during the crisis, what we try to do is just identify banks that are safe and specifically paying high dividend yields. And there are a lot of banks in the world at the moment in emerging markets still that have dividends of 5%, 6%. So there's a lot of safety in there, knowing you get your 6% dividend each year, and the loan books of those banks are growing 10, 15, 20%. But towards the end of the crisis, in fact last week, we started buying JP Morgan again, we started buying Barclays even, and we unfortunately did have some Bank of America going into the crisis. It fell, I think, 26%, but we're not quite at the bottom, but we added to that simply because the market was just totally overreacting to the crisis. And although there is still risk, Barclays trading at 0.5 to its tangible net asset value is just too cheap. So yeah, we've been playing for safety, but when the market really crashed, we thought we were going to add on some risk.
Kokkie, if you look at the breakdown of your fund, particularly your financial fund, and you mentioned that you have obviously quite a large exposure to emerging market banks. What is that split between emerging and developed? Have you tended to favor more and more the emerging market, or is that split fairly loose? In other words, it fluctuates quite a bit.
Yeah, it fluctuates quite a bit. In fact, towards the end of the 2008 crisis, let's say March, April 2009, it actually swung quite heavily to developed market banks. Because you'll recall Barclays was then at 50 pence, although we weren't brave enough to buy it at 50 pence. But JP Morgan, there were a lot of developed market banks that have become like ridiculously cheap. And doing your homework, you could see it was and the emerging markets bank to a certain extent had held up. So at that stage, I think we were almost 60% developed markets, whereas at this stage, it's about 60% emerging markets and 40% developed markets. But in that 40% developed market, there's about a 10% Japan. We bought quite a bit of Japan after the earthquake, Japanese banks. And we also bought quite a bit of the so-called catastrophe reinsurers after the earthquakes in New Zealand and Japan, because they all were hit as well. So the actual banking exposure, developed market banking exposure, is actually at this stage all fairly small.
Let's drill down into a couple of the stocks that you are prepared to talk about at this stage. Bank of America, Kokkie, it's one of the stocks that you have highlighted. Perhaps you can give us the inside track on this one.
Yeah, it's you get things wrong, and I get investors calling me and say, "Why do you buy Bank of America?" Our DNA, and we are value investors, and all my years of experience has taught me that if you buy companies when they are just too cheap, and you do your homework to verify that there isn't something dramatically wrong, over time you do very, very well. And sometimes you need patience, and Bank of America was one of those where you needed a lot of patience. The problem with Bank of America is that the regional Bank of America was not bad, and also the Merrill Lynch acquisition wasn't that bad. It was the Countrywide acquisition that was bad. And Countrywide were, with Fannie Mae and Freddie Mac and Washington Mutual, one of the main instigators of the whole home loan crisis in the US. So they just wrote very, very irresponsible lending or loans. And Bank of America, the previous CEO, Ken Lewis, was stupid enough to go and buy that, although he thought he was getting it at a discount. But the court cases are coming through the whole time against them for irresponsible lending, and they've already provided $20 billion in the last quarter. Now there was another case potentially another 10 billion, another 20 billion. So investors are starting to think, when does this ever end? But it's actually, largely has been provided for. That part of the book has been set aside. It's being managed separately, and it's becoming smaller and smaller of the bank. But the market is focusing on something that's becoming smaller and smaller. So we think Bank of America still got a long way to go, but it's just very undervalued.
Kokkie, would you have any South African banks in the fund? Are you allowed to own them in your financial fund?
Yeah. Now, we have had, you'll recall 2003, the South African banks were very, very cheap. In fact, they were then about as cheap as they were in 94 and 74. So at that stage, we had almost 15% South African banks in the fund. So we can. Look, there is always a problem in that the largest part of our investors are SA based. So they will have made the decision they want to invest offshore. But in the end, investors want you to get the best returns for them. And then an increasing number of investors are actually offshore based. So they will expect us to get the best investments in the world. And South African banks at this stage are just in between. They haven't got enough growth to match emerging markets, but are not cheap enough for the developed market valuation. So they don't look attractive enough for us at the moment.
Kokkie, then looking at emerging markets, I mean, you've mentioned Bank of America, but specifically in emerging market banks, can you maybe highlight one emerging market bank that you think we should be paying attention to that is perhaps doing some things that are unusual, that is kind of beating the trend, so to speak? Yeah.
Look, just by way of background, you've got to remember that our fund is relatively small. It's $250 million, which is not peanuts. I mean, that's about, let's say 2 billion rand. But in global terms, that is small. So we tend to, in emerging markets, be able to find smaller banks. I won't say quite the size of a Capitec, but that's the type of thing we often find. The larger developed emerging market banks are fairly fully priced. Most of them, not all. They are, like in Korea, banks are very, very undervalued at the moment. But in India, the large banks are very expensive. In Thailand, in Indonesia, so we tend to find the smaller ones. Now, one that we found that's very undervalued, we think, at the moment is a bank with a funny name or a scary name of India Bulls. A bank or financial services player that calls itself India Bulls. But there's another bank in India, by the way, with the name of Yes Bank, which also is not quite the name you want for a bank. But India Bulls is actually, it's got very good management. It's in the mortgage sector mortgage lending sector of India. The loan growth now recently again was about 40% per annum. And bear in mind that mortgages in India is still in the startup phase. Only, I think, about 8% or mortgages in India make up 8% of total GDP, where in other countries like the US it's 90%, in South Africa it's about 50%. So mortgage lending in India is still in its infancy. Here you've got a management that have started this bank 3-4 years ago, very young, good guys, and they're trading at a price to net asset value of 1, so you're getting at a tangible NAV, a dividend yield of 6% and a return on capital of 20. So, that's a player that's just being neglected because it's not big enough for large investors to look at. And as they grow, large investors will start looking at them. And that's really, getting a 6% dividend yield there while you wait, and this thing will just grow and grow. And then finally, like with Capitec, suddenly one day bigger investors will wake up and want to buy this thing. That's the type of thing we tend to find.
So that is the one for anybody with some appetite for exposure to Indian banks. India Bulls was the stock that you were talking about. I can't ignore the French banks in this conversation, Kokkie, and looking at what happened to Société Générale last week, falling 21% at one stage. BNP Paribas also down extensively. Your thoughts?
Yeah, it's overreaction. You were in the season last week, and we're still a bit in that season, although not today. But that, where fear starts ruling, and when we've got that fearful environment, then anything is possible. So on that fateful day when Société Générale fell 20%, investors were starting to believe the rumors that they didn't have enough capital. They would have to raise capital because of their large exposure to Greece. They've got a subsidiary in Greece, and they have large Italian bonds. And then just to cap it all, the French bonds were starting to run up because people were doubting whether France will need a bailout. So you had a perfect storm. And but the problem with those type of things is people also believed that that wouldn't happen in England when Lloyds took over HBOS and Royal Bank of Scotland went under and Barclays almost went under. But it is different at the moment. The banks have to a large extent been recapitalized. The liquidity is a lot better. All the sort of shadow lending banking is gone. So I think the market totally overreacted. It is very cheap. Whether it's a buy now, there is still risk. I mean, Europe, as in the previous program, I think Andrew pointed out quite correctly, there's still a lot of risk in Europe. So if you buy something like SocGen, then you shouldn't buy just SocGen, or you should buy SocGen, BNP, Deutsche Bank. You should buy 5 of them, and you'll know maybe one of them will just have a huge exposure to Italy and will fall over. But the 4 that will survive will do very well for you.
Kokkie, can I just ask you quickly, last question from me, in terms of sectors globally? Obviously, you don't just look at the financial sector, you look at a range of sectors, and I suspect you look at them mostly from a value perspective. Does the financial sector in emerging or developed markets offer value right now relative to other sectors?
Yeah. In emerging markets, the financial sector valuations are not that attractive anymore. As I said, the larger cap banks are expensive, except in China is actually one other where it's also cheap, and like Korea. In the developed markets and Japan, the banking sector is very cheap simply because of this huge fear and this mantra that banks will need more capital and therefore the returns will be lower. But that sort of has been priced in. So when we look at globally, the 2 sectors that seem most mispriced are the tech sector. If you look at things like Microsoft or even Cisco. Well, Cisco had better results. They came with a huge rally. But you look HP, Microsoft, Cisco, then that and the financial sector we find the cheapest. But at the moment, banking has got more risk, granted, but it is the cheaper of the 2.